Hello traders, Mark here from Flipside Trading, and it is Sunday, June 14th. And we're taking a look at the markets, and one of the things that we've seen is that we had a very whiplash week, right? We were all bullish and total exuberance, and all of a sudden we hit the storm and we dropped, basically almost a couple hundred points in a matter of a blink of an eye. But there were some key signals that we alerted you to. We want to go ahead and point those out and show how next time you can look for some of these pullbacks and these tops. Also then how we actually put in our SPX call vertical and how to day trade these types of markets. So getting a little bit away from the market forecast, getting a little more under the hood of how we take advantage of some of the short-term plays. So let's go ahead and dive into it, and of course that means let's get to the charts. So when we get to the charts, the key thing here's the SPX, and we're looking at the daily chart. And the key thing that we really want to see is that, look, we've had for the past 1, 2, 3, 4, 5, 6, 7, the past 8 days, right? We've gone almost straight up. Well, that type of exuberance is always kind of a watch sign, because the market, always goes back to reversion of the mean. It's a kind of a step function. It doesn't travel, the same way in one straight line in one direction. So we're looking at that type of thing. And you can kind of see here, if we take this away and make this a little bit bigger, we had this doji here on Tuesday, and then we had an outside bearish engulfing on Wednesday, and boom, the big drop Thursday. So there's a technical signal right here that started it. But the key thing that really started it all, at least for me, and that we put out to the overall subscribers, what was happening with the VIX. So right here, what we're looking at is the QQQ, which is basically the NASDAQ 100. And the ETF there, and we can see, just as we saw on the SPX, is that we have this irrational exuberance, if you will, basically moving straight up. And this is in the strongest index of all three, right, between the NASDAQ, the SPX 500, and the Russell. But what was happening, what was really interesting, as this was moving up, our overall trend was also up on the VIX, and that's what we're seeing below here. And when the VIX starts to move up and we still have this irrational exuberance, you can see from the past that when you had that type of correlation, it always led to some type of a pullback, right? Where here we are, we're moving up, kind of, irrational. The VIX moves up and we pull back. Same thing over here, right? We're moving up 5, 6, 7, 8 days in a row. The VIX is kind of coming with it instead of dropping, and we pull back. So that was a key signal that we went ahead and pushed out. But there were some other key signals as well. And some of those key signals have to deal with the underpinnings of the market itself, right? As we talked about, we'll go back to the SPX here. As we talked about, one of the key underpinnings in the SPX is the financials. And one of the key financial indicators I'd love to look at is the regional banks. And you can see that the regional banks, as they come back up, and Thinkorswim does a little bit of thinking here, you can see that we had this hanging man doji right here. We're underneath the 200 moving average. So we have a natural resistance point starting to come up and a bunch of indecision. And the same thing with the transports, right? Kind of one of the other key drivers, if you will, of this economy and the market itself, especially S&P 500. And you kind of see that same thing, right? We got a hanging man, and then the next day we actually drop below the 200-day moving average, all right? So that again gives you this signal of, whoa, we're not moving in the same direction. As we looked at before, we could be due for a pullback. Now we don't know the order of magnitude of this pullback or what it can be, but a pullback to the mean, back to the 80 EMA for sure is definitely something to think about. Now there were some other key areas as well, and we have to look at some of the risk on, risk off indicators that we looked at that kind of correlated that some, and that's the Japanese yen. Now the Japanese yen, as you can see, as the market moves up, the yen usually sells off because it's a carry trade. What happens is traders go ahead and they sell the yen, they take the profits for the yen, and then they push them back into the U.S. markets. Well, you can see that money was starting to come out of the U.S. markets and started going into the yen, indicating an overall risk off. And again, we crossed the 200-day moving average here, indicating again kind of a rotational shift that something may be afoot. The other thing we have to look at is the overall put-call ratio, right? What are investors doing, and how does the market react to that? If you look at the put-call ratio, you can see that that ratio, coming all the way down here, to this point, is like at almost an all-time low. Matter of fact, a low from probably the past, 2 or 3 years. And you can see that a little bit better if we back out a little bit. And you can see that if we, draw kind of that line across, coming all the way back, through December 18. Oh, sorry, wrong place. Right here, we haven't even come close to touching that in that whole period. And so the market, as everyone runs to one side of the boat and you get to extreme, it loves to go back to the other side and trap folks, because that's what the market does, and that's how they make money, right? There's a lot of liquidity. People are on the other side. They're all buying calls that they mean they had to sell those calls, and so now they have to, maintain their overall delta neutrality. And the best way to do that is to, sell off the market and collect that premium. So, that's basically, what they did. The other key is that we need to look at is the NDX itself. And if we take a look at the NDX, which is that leading indicator, the NASDAQ 100, here we were in this, channel, chugging along nicely, showing, should we say, a respectful rules of growth, of kind of bouncing back in this overall stepwise fashion until we basically popped out of the channel. When you pop out of the channel like that, it usually means it's overextension and you get that reversion to the mean. And that reversion to the mean, here on the NASDAQ, is really, not only the 8, but reversion to the mean for most traders is kind of that 21, the 20 EMA or the 21 EMA. And so that's, basically what we saw happen, and we took a look at that. Now, given all that, did I short right here? The answer is absolutely not. I didn't. But did I take profits? Definitely. Did I go ahead and tighten shorts up on a bunch of my longs? Absolutely, right? Because there's still a chance that the market can move up. I didn't get any signal, right? I just got a preponderance of evidence that would probably pull back, but I didn't know when, I didn't know how, and I didn't know how much. Okay, so now that it did pull back, we know that it happened. Okay, it happened on a Thursday. And so the market, actually, you can see here, it gapped down, almost 50 points. But given all this evidence, we kind of know or potentially have a feel that it may go down even further. And if it's going to go down even further, therefore we want to put down a call spread. And we want to take advantage and trade that. So let's take a look at why we think it might go down further over the next 24 hours. So let's go back to the futures chart. And the futures, what they show, we're going to see here, we're going to switch it from the daily to the hourly here in a second. Here we go. We're in the futures. And we're going to pop down to the hourly. And I'm going to go ahead and pause this. I'm going to put on a different indicator for you. 1 second. Okay, we're back. So what we're looking at here is the ES futures, right? The ES mini futures, the S&P 500 futures. And we're looking at basically the hourly chart. And what we have from the hourly chart, you can see here is the area that's highlighted in gray in the top of and the bottom is the value area for the week. And what happens is if we stay above value for the week, and value is actually defined as where, basically the majority of the transactions took place, in a time and a volume perspective, for that price auction to give you that balance of value. And in this case, we started, as this value area came through for the week, we started outside the value area. And if you start outside the value area, if you come into it, okay, there's an 80% chance that we're going to go all the way from the top to the bottom, right? And so we enter this, here is, Wednesday night, and it's kind of, Wednesday right here is where we kind of, open the market, right? And so if we come all the way through on Thursday, right, we come to this piece and we say, okay, now we have an 80% chance that the market is going to at least go ahead and test that. Therefore, that's going to give us, not only do we have negative momentum on the hourly chart, but given this preponderance of this may be the overall target area, we have a high probability, we're definitely go ahead and set this as a call credit spread. Now, one of the things that always happens is that when we have kind of this 100% sell-off overnight, is the market becomes a little bit out of balance, right? Because it's basically net short. what happens, and you can see it right here. Let me see if I can go ahead and highlight that for you. Is that this candle kind of represents when things are out of balance. There's some basically short selling, recovery, if you will, and taking of profits in order to put the market back into balance. And so that's kind of the area we're waiting for, that kind of pullback, okay, to go ahead and set that, and set that trade. And so you can see that, right around here, right around this 8 o'clock, 9 o'clock area, that's where we want to go ahead and set the trade. And that's exactly what we did, right? If you look at the overall text that we sent out, I think it was at 8:06, and we sent that trade out. And we'll go ahead now, and we're going to kind of look at a much more granular level of the S&P 500, and we'll take a look at that here. And this is basically, okay, 1,000 tick. Now, a tick is basically every time that there's a buy or sell in the ES, that it actually, shows up as a value. And then if you get 1,000 of those, then actually paint a bar. And the advantage of using ticks versus a time base is that it's much more sensitive to momentum. And you can see here that right around this, here we are on the 11th, right? It's Thursday, where we want to set this up. And right here is, we had the high, we kind of bouncing the high, and you kind of see it coming down. So to me, this is kind of showing that we have a lower low, lower high, and this is where we went ahead and set the trade. And as you know, what happened is that the market actually did. It came all the way down. It hit that value area, and it had the 80% follow through. And so one of the key areas so the bottom line is when we set this, the volatility was so high. You can see that we're set up here at basically, this is called 3110. We were able to put a short call vertical up at 3205, basically 100 points above. And so that gave us a pretty good cushion. We were able to sell that for 20 or 25 cents. And as we know, the market actually pushed down, and that by the end of the day, we come all the way down here to about 2 o'clock. Here we go. And let's say it closed around 30.20, and we were at 32.05. Well, basically, we have about 195 point cushion. We're almost at max profit during the day. So we're having a great trade. So the question is, how then can we take advantage of not only the short call vertical, but how can we, day trade this and make some money on this the next day? Well, let's go back and talk about the S&P 500 and what happened on the charts. So we know from the hourly perspective is that as we came through, we broke here. So we came down to 29.92. We bounced back, and in the morning when we bounced back, we hit this, basically support becomes resistance, and we're saying, hey, we're bouncing up against this pre-market. And actually from a Twitter standpoint, we put that out there. And we'll close that, and we'll kind of show you. And we'll go back, and we'll say, where are we? Okay, that's where we're coming all the way through. Okay, we've put it out, this one first, and we said, hey, oh, it's not that one. I made a mistake. My bad. Let's go back to, here we go. This is, we're looking at, kind of this pre-market, and we're saying, hey, we're kind of feeling this. This is a key, looks like this is key support, key resistance right here. This may tell us that the market may want to come back down and retest 29.92. Well, in fact, it did that. I mean, if we take a look and we actually show it from that next standpoint, we actually said, okay, here it is. We had basically a look above, it failed, and we started moving down. So again, that 30.60 level is key to saying that, hey, we can go short, because now we have a really good level of, to put our stop that's really close, and trade location is one of the things that we really need. So if we go back and to the charts, and we come back here and we go back to our 1,000 tick, and we look at back on the smaller time frame, and you can see, let's move up to that morning. Here's that 745. Okay, here's the area where we went ahead. We bounced into that value area. That's our look above. We're looking above, looking below. Remember that 30.60. So that's right around. Let's do a screen draw for you. Right, that 30.60 is right here. So we came back and we retested that right on the larger 1 hour time frame, It then corresponded with our lower time frame market rules of how to trade. So let's take a look and explain what some of those rules are. Let's kind of take this off for a second. So the first thing is here, what's really important is this dashed line is a 50 exponential moving average of the 50 exponential moving average. So it's a moving average of a moving average. On top of that, we have our 50, our 34, and our 21 exponential. And you can see as we pull back, right, we still maintain the integrity of the stack. The 50 is above. It's above the 50, right? The 50 is above the 34. The 34 is above the 13. So we're in really good shape right there. The next thing we want to say is, okay, let's look at trend. What are we seeing? Here we have a higher high, but now we have a lower low and a lower high. Now we have a lower low and potentially another lower high, again, coming into our resistance area. This is telling us that we have a downtrend. This right here is a micro trend. We know this is a micro trend because we go back and look back at this last, should we say, last drop. Let me get the right tool here. And we can see that this drop, we have not violated a new higher high within this drop, which makes this a micro trend, such that we know that we have, if we break that trend, we definitely can go short. So what I do is I don't trade the futures very often. I usually trade the SPX or the SPY. And so now we're in short and it moves down. We stay underneath the moving average. And once we cross, we're out. So now we come back to almost the same type of a setup. Look at it again, right? We're at a trending day. Again, we still have, right? Lower high, lower low. Now we start getting into this micro trend. Remember, this micro trend has not violated, all right, this last drop, right, from lower high to lower low. That's when we know it's a micro trend. So therefore, we know that we pull back underneath here. And as we drop down, we can see that we've also crossed momentum, crossing zero. And our overall, should we say, moving average stack has remained intact, right? We don't really have any crosses. This tells us we have another continuation pattern. We follow this all the way down here, right? And we cross, you know, the moving average on the 34 EMA, and we're out, okay? So those were some, you know, really good trades, you know, in order to how to take advantage by looking at the higher time frame, looking at the lower time frame. We had the same thing here. I did not take this trade here, even though potentially you had it. The reason why I didn't is because I didn't see this as a micro trend, right? Because this reach moving up forward for me, okay, from here, oh boy, that's not what I want to do. Sorry, guys. Let's see. Let's make this just a little bit bigger. Now we move down a little bit. Here we go. Here, where was it? Right. Yes. Okay. So that's nope. We're still not where we need to be. There it is. So I did not take this next short on the leg down because we went to the screen draw. This reach right here, we had two things happen. Number one, we had a lower, a lower high, right? Or basically a higher low. We broke this level right here and we moved up. So this reach, right, broke this reach. So therefore, to me, I did not have I'll call it a viable trend. Now, there was a potential trade, you know, on the pullback at this point, but we were just so overextended. I mean, we're down about 160, 170, 180 points that it just didn't make sense because I still had to break this key level of support as well. And looking from here to here, the risk reward just did not seem to meet my eye in order to take that trade, because this is basically a 1-to-1 ratio versus if I put my stop right here. So, you know, I did not take that. Okay. Now, You could have taken, there's some minor ones here. Again, we broke trend. Okay, we pulled back. Now we're on the opposite, right? We have basically a little bit of an uptrend, and we can look at, breaking this. We're above zero. We have our moving average stack, and we could have caught it a little bit here. Now, I didn't take this trade either. And the reason I didn't, because when I looked at the market internals, everything was pinned, right? It was just such a down low day. It didn't make any sense at this juncture, given that we had such a long push down over basically the past 20 hours in futures, that I was not expecting any type of a huge V-type bottom or to make this happen, right? The market just has so much momentum. It just takes a while to turn that battleship. And we did get some opportunities to do that, and we got that a little bit later. And let's see, we picked it up right. The only one long I took this that was right here, because we had increasing momentum. And let's draw that from here. You see our momentum was moving up. We had this cross. We broke this trend, and then we pulled back right here. So we took the trade right about here with our stop. And that made sense because our target was, kind of in this area where we got out. That was probably, I think, the only long that I took, that entire day. So there it is, guys. That's how you have it, okay? We showed you now how to use, multi-time frames and trade on the pullback, using a trend, looking at micro trends, making sure you have a moving average stack, making sure your momentum is definitely, in this case, going short, moving down or below zero. It's a really good way to make this. Just have a trailing stop or use your moving averages, either the 34 or the 13, as your overall, should we say, target point. And, that's really useful. Again, using the value areas, help us set up that, that key resistance in order to start taking a bunch of shorts. And again, setting up the call vertical, we had just this preponderance of information saying that we're going to be short. We were definitely oversold. We expected a bounce in order to bring everything that was out of balance back into some semblance of balance, and that's where we're going to put the trade. So I hope that was helpful. Enjoy the rest of your weekend, and we'll catch you on the flip side. Thanks.